Well, hello and welcome. My name is Chris Tanner, and on behalf of New Direction Trust, I want to thank you for joining us today. Uh, Today's webinar is an interesting topic, one that we've never really discussed in this way specifically, but we thought would be a nice break from some of the webinars we normally do and kind of a different way to view the way we save, the way we invest, and are there some different opportunities and different ways to do that? Before I jump in and get going, I just wanted to go through a couple of house cleaning items. And the first thing I wanted to make everyone aware is you are muted, meaning I cannot hear you. And I mention that because there are likely to be questions today as a result of some of the things that we cover. And the way that we're going to answer questions is by using the question feature on the GoToWebinar platform here. And so if you're at a computer or on your smartphone, however you're listening, kind of on the right-hand side, there's a little triangle, and next to it, it says questions. And if you click on that, you can type in a question. And I will read those questions and answer them to the best of my ability. And we're actually going to save all those questions till the end. But that being said, if a question comes to mind, please do type the question in. And when we get to the end, I'll get through as many of those as I possibly can. If for some reason I'm unable to answer a question, or if a question comes to mind after the fact, I'll have some contact information for New Direction Trust, so you can reach out to us directly, and we'd be happy to answer those questions for you. Okay, let's go ahead and jump in. The first thing, we have the safe harbor statement, and the bottom line is today's presentation is meant to be educational. We're providing information, but we are not offering investment advice. We're not offering any type of tax advice. These are just ideas and thoughts, and we would encourage you to seek the advice of a competent professional. That could be your CPA, a financial advisor, maybe a tax attorney, whomever it is that you work with that's a trusted advisor for you. And so, we're not offering any investments or advice specifically, just education today. And I know many of you are already familiar with New Direction Trust, but before we jump into the meat and potatoes of today's presentation, I did want to just share a little bit about New Direction Trust, especially for those of you that aren't familiar with us and what we do. Wanted to let you know that we are celebrating our 20th anniversary this year. And so New Direction Trust has been around since 2003. And we had some humble beginnings, but have really made big strides and grown into a well-respected company in the self-directed IRA community. And for those of you that are not familiar with what we do, New Direction Trust offers retirement plans. And so as we go along, we'll talk about the various types of retirement plans, but essentially any type of retirement plan that is out there and is available, we would offer that. So we offer IRAs, 401ks, we even offer health savings accounts. But what makes us different is that, number one, we don't provide investments or financial advice. We're a self-directed IRA company. And so what that means is that our clients choose the investments that they want to work in. And more importantly, we offer the ability or the freedom for our clients to invest in a wider range of investments. Most retirement plan providers allow you to invest in publicly traded securities, and that's really your only option. So if it's a publicly traded security, you can invest in it. Whereas we open up some opportunities in the areas of things like real estate. You could invest in precious metals. You could invest in private businesses. You could potentially loan your money out to a business or another person. So we open up the opportunity to get into some Additional investments, you'll sometimes hear those called alternative investments. And so you can still invest in publicly traded securities with us, but we give you the opportunity to open up the doors to quite a few more investments. And if you have any questions or want a little more information about that, by all means, we'd be happy to chat with you and explain how that works. All right, so let's go ahead and jump in. I'm going to start off with some questions. And some of you, I would anticipate, have seen this before, so this won't come as a surprise. And for some of you, this might be a little bit new. But I wanted to start off and ask this question. If I were to tell you, and of course this is hypothetical, but if I were to tell you, I will give you $1 million today, or if you're willing to be patient and wait 30 days, I will give you whatever the result of a penny doubled every single day for 30 days. So on day one, I give you a penny. On day two, it doubles. So now you have 2 pennies. On day 3, it doubles. You get 4 pennies. You get the idea. Every single day, that penny doubles, and it does it for 30 days. And so the question is, which would you rather have? Take your $1 million right now today, or would you be patient and wait 30 days for whatever the result of this happens to be? And so one of the questions I like to add to this is, how would you decide? And this is a really simple mathematical equation. And so if you were to double that penny for 30 days, you would come up with a result. There's a specific reason that we decided to start with this, and that is that some of what we're going to be talking about today is going to be talking about some choices and decisions that you have. And ultimately, a lot of these choices and decisions are based on math. And so when you do the math, or if your CPA helps you with the math, it'll give you a good feeling for, does this make sense for me? So let's go ahead and I did the math. And if you were to wait 30 days, a penny doubled every day, you would have a little over, well, quite a bit over $5 million. So $5,368,709.12 to be precise. So I don't know about you, but I would certainly be willing to wait 30 days to get more than 5-fold the amount just by waiting for a little bit of time. So assuming my health is okay and I don't have any reason to believe I'm not going to be here in 30 days, I absolutely would wait for that bigger sum of money. And so we talked a little bit about, well, why would we start with this? And the concept, the idea is, of course, that we have some decisions and we have choices in life. And part of what we're doing today is educating you on some of those choices so that you can begin to make some mathematical decisions like what makes sense for me in my situation. And what's interesting about this is that if I had shifted the question just a little bit and I had said a penny doubled every day for 25 days or for 26 days or even 27 days, the result is different. And so on day 27, when you're doubling a penny every single day, you have less than $1 million. And so one of the takeaways from this also is that it takes some time for that penny to double. And in fact, it's not until day 28 that you are better off waiting than to take your $1 million on day 1. So just planting a seed there that time matters and doing the math matters. So I'm going to ask another question, and there's a very specific reason I'm asking this, because this actually surprised me a little bit too. And that is, if I were to ask you, which of the two consumes more of the average American's income? These are two things that virtually all of us pay, and that is taxes and interest. Interest on debt, to be specific. And so when you borrow money, and the real common examples here are when you borrow money to buy a home, borrow money to buy a car, when we use credit cards, there's interest. You know, when you borrow money, banks are going to charge interest. And there may be some of you that are fortunate and you have no debt, and maybe you have no interest that you're paying, but I think that's not the vast majority of Americans. I think the vast majority of Americans, they are paying some form of interest when they borrow money. So which would we think takes up more of the just typical American's income? And the answer is it's taxes. And the average American, and this is over their lifetime, this isn't like a 1-year snapshot, but over their lifetime, they'll pay about a third of all of their lifetime earnings will go towards federal and state income tax. And I like to point out here that this doesn't include other taxes. We're just talking about income tax. So we know that you pay sales tax. We know that there are property taxes. We know that when you register your vehicle every year, there's a tax on that registration. So we're just talking about income tax, federal and state income tax. And I know that varies for people depending on your tax bracket, what state you live in. Some states don't have a state income tax. Some states have a higher double-digit income tax. Some are kind of in the middle. But I was actually a little bit surprised when I learned that you can anticipate for the average American about a third of their income is going to go to paying taxes. So then my question was, well, that's interesting. Well, how much does the typical American pay just on debt? And so this number comes from the Federal Reserve, and the most recent data they shared was from the end of 2022, the fourth quarter of 2022. So the typical American, once they get that income in their pockets, they pay just under 10% of their income goes to paying debt. And so when you back that out and you think about that, the typical American, if you take that roughly 10% and add it to that 1/3, about 44% of Americans, they're paying, their income goes towards taxes and debt. So not quite half, but getting right up close to half. It was a little bit interesting, a little bit scary actually when I saw those numbers. And so I wanted to talk a little bit about something, and Einstein had a famous quote, and he was talking about compounded interest. And there's a reason we're also talking about this. Einstein said the eighth wonder of the world is compounding interest. He basically said those who understand it earn it, and those who don't pay it. So it's understand, what the interest is and the compounding effect. And so let's go back to our penny being doubled every day for 30 days. That's an example of compounded interest. You start with an amount of money and you compound it. There's growth. In that case, every day, but for some of us, it's every year, it's every month. But it's a powerful force. And the more you have time on your side, the more powerful that compounding is. But I also wanted to point out that there's a negative side to this compounding, this concept of compounding. We saw how powerful a penny doubled every day can be in just 30 days and how big that number grows. We know that it takes a while for that compounding to take effect, but it's kind of like rolling a snowball up a hill. You roll it, roll it, roll it, roll it, it's growing, growing, growing. And when you get to a certain tipping point, that thing takes off. And when you get it on the downside of the hill, that thing really grows and starts to move very, very quickly. But there's a negative side to this compounding, and that's the compounded taxation. And you could also think of interest that you're paying on debt. When you continually have to pay taxes, when you continually have to pay interest, what that does is it's taking away from your ability to grow your wealth, to grow your nest egg, because you're always having to pay interest on debt and continually paying taxes. So when you earn wages, when you have capital gains on investments, when you have rents coming in, when you get dividends or interest, maybe you have a CD in a bank account and you're earning interest on that, or you just have a savings account where you're earning interest. A good rule of thumb is if you get a W-2 A 1099 or a K1, those are taxable forms of income. And so whenever you're being taxed, of course, the ability to grow that is less because some of your taxes go into Uncle Sam or to pay off that interest. So with that in mind, we want to talk about a concept of, and I like to just think of this as buckets of money. And as a general rule of thumb, the kinds of money that you have the ability to work with fall into these three categories. There is the taxable bucket. We're all very familiar with the taxable bucket. This is money you earn from your wages. So if you have a job and you earn a W-2, that's in the taxable bucket. If you have a brokerage account where maybe you're investing in stocks or mutual funds, uh, interest, dividends, capital gains that you earn in there, those are taxable. If you have a job or you do something that generates a 1099, that's taxable. And so 1099, that could be things like CDs, maybe you loan money out and you earn interest, but when you earn interest, interest is a taxable thing when it's done on the taxable side. And then we have this other bucket of money that's the tax deferred. And what's interesting is that this tax deferred bucket, the ones that we're most familiar with, really didn't come into being until the mid 70s. And so things like a traditional IRA, 401k, a SEP IRA or simple IRA, and the one I didn't put in here, but maybe should have, would be pension plans. We don't see those as often anymore, but some people absolutely are getting money through a pension plan, and that is taxable. By the way, and I thought about putting this in here, but I didn't. And this is a surprise to some people, but did you know that when you are eligible to start taking Social Security, uh, it is possible that up to 85% of your Social Security is taxable uh, if you make above a certain threshold. And that threshold is, if you're married filing jointly, is a little over 30,000. If you're single, it's something like $27,000. So if you have income higher than those thresholds, Social Security is also taxed. So we don't call it technically a tax deferred, but it is income and it is taxed depending on how much income you make when you're collecting that Social Security. Then we have the tax-free bucket. And I want to confess something. When coming up with the title for this webinar, we said forever tax versus never tax. One of the things I want to make very, very clear is that when we talk about these tax-free buckets, the Roth IRAs, there's this typo there. It's HSA. The darn spell check does that on me. But HSAs, some types of life insurance, and then some other Roth retirement plans, you pay the tax one time. So it's not like there was never a tax, there was a one-time tax. But the bottom line is that with those accounts, you pay the tax one time, you put the money into those accounts, and they have the ability to grow both tax-free, but also more importantly, be taken out or distributed tax-free. And so wanted to just talk a little bit about these in a little bit more detail because there are pluses and minuses to all of them. So in the taxable account, the pros are, of course, that this is the liquid money that you have available. This is the money you're using to pay your mortgage, to pay the car payment, to go grocery shopping, to pay your utility bills. So this is an important bucket. You know, this is a bucket you need to have. The question is, how much do you want to have in that bucket? And of course, it's a good idea to have an emergency fund or some reserves just in case. You know, the car breaks down, you got to get a major repair. The furnace goes out, you know, things happen in life. We want to have some easily accessible money available, and that's where the taxable bucket comes in. The negative side to the taxable accounts is that this is where the forever tax comes in. In this bucket, anytime you have new earnings, anytime you have growth, like if you earn interest, you are paying tax on the growth, on the earnings, on the interest. Every single year, you are going to be paying that tax. And that tax doesn't go away until you die, unfortunately. So there's no escaping those taxes. So think W-2, think 1099 income, think dividends, think those types of earnings. So let's shift gears now to the tax deferred. So tax deferred works a little bit differently. And another way to think about this is tax postponed. So tax deferred, think like an IRA or a 401k at work. The IRS is saying that you can put money aside, and if you put money aside into this tax deferred bucket, we're not going to tax you this year. As a matter of fact, when you put money into this bucket, we're going to let that money grow tax-free until you take the money out. And so we call that a distribution. So a couple of things to remember here is that there are some rules. And so some of the downsides of putting money into this tax deferred bucket is that prior to the age of 59 and a half, the IRS doesn't allow you to access these funds without a penalty. And so for most of these accounts, there's a 10% early withdrawal penalty. And the idea is that this is for retirement. And so we're going to put a little, burn or a little pain in there if you go and get that money before the age of 59 and a half. Once you reach the age of 59 and a half, you can access these funds. Keep in mind that when you access these funds now, when you take the money out, it is taxable, and it's taxable as ordinary income. So it is subject to federal income tax. It is subject to state income tax. And so one of the things that's interesting about this is that you're putting money away now, and at some future time when you take it out, there's a little bit of a risk that we don't know what the tax rates are going to be in the future, and we may not know what our tax bracket is going to be. And we're going to go dive into this quite a bit more here in a little bit, but those are the cons. There's a little bit of an unknown because we don't know what the tax rates are going to be in the future, and we don't necessarily know what our tax bracket is going to be, but those are going to be important factors to consider. And then I wanted to go into a little bit more detail on what I call the tax-free vehicles. And the reason I listed the health savings account first is that I can honestly say this is a tax-free vehicle. If you're not familiar with the health savings account, I would say double check and see if you are eligible. And the reason why is this has a unique quality, a unique feature that you can't find with any other investment vehicle. And that is that the contributions that go into a health savings account can actually go in tax-free. And when I say tax-free, I mean nothing. So no FICA, that's the Medicare Social Security tax that comes out of our wages, no federal tax or state income tax. That makes this product unique. Nothing else works quite like that. So for example, when you put money into a tax deferred like a 401k, you have to pay the FICA first. So that contribution that goes to future, Medicare and Social Security, that comes out first, and then the federal and state income tax is withheld. You're not paying the tax on that, but the health savings account, no tax going into that account. So one of the key questions is, well, how do I know if I'm eligible to put money into this account? And it has to do with the type of health insurance that you have. If you have an HSA eligible plan, you can put money into this account. And if you don't know, you could call your insurance company and they will tell you. For the most part, these are high deductible health plans. If you're on a different form of health insurance, like you're not covered by your employer, so let's say if you happen to be on Medicaid, if you're on Medicare, those are not HSA eligible type health insurance plans. So we're mostly talking about private health insurance, high deductible health insurance. But if you are eligible, you can put money aside, and the secret to this is that this is for medical expenses. So the key thing is here, if you put money into one of these plans, it can grow tax free and you can take money out tax free as long as that money coming out, those distributions are for qualified medical expenses. Now, we've done whole webinars on what are qualified medical expenses, but these are things like you go to the doctor and you have a copay. This is, co-insurance. You go and health insurance covers 80%, you're responsible for the 20%. Well, that's a qualified medical expense. You had to go to the emergency room for something and you're responsible for 20% of that cost. Prescriptions, eyeglasses, there's a whole, a lot of different things that fall under this category, but that's the idea. You're putting money aside for healthcare. This isn't for, I want to go on a vacation. You pull money out and that money goes towards a vacation, that becomes taxable. So this is a unique product and it's one that I don't think a lot of people are familiar with, but if you are eligible, just from a pure tax perspective, it's the only chance you can put money in tax-free, grow it tax-free, and take it out tax-free for medical expenses. Just FYI, for 2023, if you're single, you can put up to $3,850 into one of these accounts. If you happen to have a family health insurance plan, you can put up to $7,750 as a family contribution. And then if you're over the age of 55, there's an additional $1,000. It's like a catch-up contribution that you can add to those. These health savings accounts, just so you know, they can be invested. So it could be in a bank account that's earning interest, but we also offer our clients the ability to take these accounts and they can invest it in anything an IRA can be invested in. So our clients can invest in, publicly traded securities, real estate, anything that an IRA can be invested in, a health savings account can also be invested in. The IRS kind of lumped this in with IRAs when they put these together. So pretty cool vehicle. Going to mention this briefly. This is not something that New Direction Trust does, but just to be fair, there are whole life insurance policies that, when properly structured, can provide tax-free income. Some real famous people have used these, and there's some interesting stories behind these. Some of these people use these types of plans to help start their business or fund their business, because at the end of the day, what you're doing is you can actually borrow from a whole life insurance policy. And when you borrow money, it's not taxable. And it's a little bit like in a 401k, when you borrow money from your 401k, a loan is not a taxable situation. And so you will sometimes see these referred to as a rich man's Roth. And one of the reasons why is there are no income limitations on putting money into these plans, and there are no contribution limits. Just to be fair, to let you know that that is something that's out there. The other types of plans that we're probably more familiar with, the ones that New Direction Trust works with, are the Roth retirement accounts. And one of the things I wanted to make you aware of is that at the beginning of this year, the Secure Act 2.0 went into effect, and Rothification is not an official word, but what happened is the Congress changed the rules on Roth contributions, and beginning in 1997, the only type of Roth account you could contribute to was a Roth IRA. So prior to 1997, Roth type accounts did not exist. The only option you had to put money into a retirement account was tax deferred. Now, any kind of employer-based retirement account, so that could be a 401k, a 403b, it could be a SEP IRA, it could be a simple IRA. There's the potential that you could put money into those Roth accounts. Now, the reason I said potential is that if you work for a company, the employer is not obligated to offer a Roth type 401k or 403b, It is still their option. But what we're finding is more and more employers are wanting to give that option to their employees. But the good news is this: you have more options and more opportunities to contribute to a Roth plan than you've ever had before. And some of these, I think we're going to see kick in more so in 2024. They passed this law right at the end of 2022. They didn't give the financial companies hardly any time to adjust and make these offerings. So there will be a little bit of an adjustment period, but I think the ability to put money into Roth type accounts has just grown significantly. So we're going to talk about these accounts just in general. So the Roth IRA is one most people are familiar with. A couple things to be aware of. One is that there are income limitations. So the short of it is if you make too much money, and I've listed those here, you cannot make a Roth IRA contribution. So if you are a single individual filing as a single taxpayer, when you hit the 138,000 mark, your contributions begin to phase out, and by 153,000, you can no longer make any contributions to a Roth IRA. And then married filing joint is the next bracket there. Similar story. Once you get to 218,000 and then up above 228,000, you cannot make Roth IRA contributions. Something to be aware of is that when you make a contribution to a Roth IRA, the contribution is always tax and penalty free when you take it out. So I mention that because we have some clients that will put money into a Roth IRA, just for example, maybe for their grandchildren or their children. And by putting money into a Roth IRA, and of course their children have to have some earnings, that can almost work like a college savings plan. So the contributions, and that's the key word there, the contributions can be taken out tax-free and penalty-free. Why? Because you've already paid the taxes. Some things to be aware of with the Roth IRA: they are not subject to required minimum distributions. Tax-deferred retirement accounts are subject to required minimum distributions. So that means when you hit a certain age, whether you want to or not, you must begin taking money out of that account. Roth IRAs are unique, they're different. If you don't need the money and you don't ever want the money, and maybe you're just wanting to leave that money to your heirs, leaving a legacy for them, which is a wonderful gift because they will be able to take money out tax-free also, but you're not required to. You can take money out if you want, but you don't have to. Okay, let's talk about slightly different kind of money, and these are conversions. So a contribution is when you put money into the account. A conversion is when you take money that's in a tax deferred. Let's just use an example. The most common one we see is somebody has a 401k with an employer, and they move that 401k into maybe like a traditional IRA, and the person decides to do a conversion. So a conversion is different than a contribution. A conversion is we're taking money in a tax deferred account, paying the taxes, and we can do a conversion on the entire amount or portion of it. And when we do a conversion, there's a 5-year clock that begins ticking. So when the Roth IRA first came out, there was a little bit of a glitch in the system. And so what happened is people figured out, well, geez, if I do a conversion, I can take that money out immediately and not pay any taxes on it. Doesn't matter how old I am. Doesn't matter how long, like I could convert it the next day, take it out. And so Congress fixed the little glitch, so to speak. That's where this 5-year clock came in. So you would pay a penalty if you decided to take it out right away. So just be aware that every time you do a conversion, there's a 5-year clock for that specific conversion. So if you're doing a conversion this year and a conversion next year, there's a different 5-year clock. And basically what this means is that you need to wait for 5 years. And by the way, the clock starts ticking on January 1st of the year you do the conversion. So if you did a conversion on December 31st of this year, the clock actually goes back to January 1st. So just something to be aware of. So we have three kinds of money in Roth accounts. We have contributed money, we have converted money, and then we have earnings or growth. Think of, you're making money on your money, there's growth in the account. So earnings within a Roth are subject to a 10% early withdrawal penalty if you take them out prior to 59 and a half. Once you hit 59 and a half, the earnings can come out, the contributions can come out, and as long as there's been a 5-year clock on the conversions, that can all come out tax-free. So earnings can come out tax-free when the 5-year clock has been satisfied. There we're talking about conversions and your 59 and a half. So just some rules to be aware of with the Roth IRA. All right. Couple of points on Roth conversions. And I want to make a point here at the end, and I believe it was the end of 2021. I want to make you aware that Congress was wanting to institute some changes on Roth conversions. They wanted to effectively eliminate them. And so just keep right now, you have the ability to do Roth conversions, but the Congress's eyes were on this. And so just keep that in mind, that you want to be aware of what's going on with Congress and any new rules that might be coming down the pipe. As of right now, there's nothing like that, but there was some proposed legislation that would have gotten rid of Roth conversions. But as we sit here today, anybody can do a Roth conversion. So it doesn't matter how much or how little money you make, the income makes no difference, and there are no dollar limits. If you have a $500,000 tax deferred account that you want to convert and you're willing to pay the taxes, you can convert it. I'm going to mention just quickly something called a backdoor Roth conversion. So there are individuals, because they make too much money, they can't contribute to a Roth IRA. They'll contribute to something that's called a non-deductible traditional IRA, and then they can convert the non-deductible traditional IRA to a Roth. So the bottom line is, even though you make too much money to contribute to a Roth, there are ways to get money into a Roth. What is more common, what we tend to see more often, is that people are converting an existing tax deferred account. So think traditional IRA, think of 401k with your employer, where they haven't paid the taxes yet. They're converting that to a Roth. The bottom line, the reason we're going through all this is to let you know that if you are sitting here today and you have none of those tax, we call them tax-free plans, but if you don't have an HSA, you don't have any of these Roth type accounts, there are ways that you can get into these types of accounts. And so when it comes to Roth conversions, I just want to point out that there are some considerations. And at the end of the day, we would say consult your CPA, but there are some things that I think factor into this decision. One is, what is your current tax bracket? And I'll use kind of the extremes of this. If you happen to be somebody who's in the top tax bracket, you're paying 37%, a Roth conversion may not be as appealing to you. If you happen to be in a lower tax bracket, in fact, I was just working with a couple who they're right around the age of 60. The wife retired last year. The husband was retiring the 1st of June this year. And so what was interesting is that their income in 2023 was going to be significantly less than it was in 2022. So their tax bracket was lower. And so because the tax bracket is lower, that could be an opportunity to take advantage of a Roth conversion. What is your age? Mention that because you have to do some math when you're doing this conversion. If you pay the tax now, as a generic rule of thumb, and everybody's situation is unique, but the younger you are, the longer you have for those Roth accounts to grow, the Roth conversion tilts in your favor. The older you are is sort of the reverse. If you're 85 years old and you do a Roth conversion, we don't know what your timeline is as far as how much longer can you grow that Roth account? Some other things to keep in mind is future tax rate and future tax brackets. Uh, Future tax rates are a little bit of an unknown. Congress can raise or lower taxes or keep them the same. We're not in control of that. Your future tax bracket is more in your control. It's how much income do you think you're going to be making in the future when you might be taking money out of this? But I'll give you an example. Right now, we are in a tax bracket or a tax system that I believe went into effect in 2017, and it is set to expire on January 1st, 2026. So if Congress does nothing, the tax rates are going to go up in 2026. And so in your mind, you have to decide, do I think taxes are going to stay the same? Are they going to go up or are they going to go down? Because that factors in to the equation. And then obviously consult with your CPA. All right, let's jump in. This is the fun part. We're going to jump in and look at a couple of case studies, I'll call them. And the reason we're going to do this is I want to take a look at some real examples to understand why you would think about putting money into the buckets you do. And so here are just some general questions to keep in mind. And this question would be, so is it better to pay the tax one time? And maybe we're putting our money into a Roth IRA as an example. And then let that Roth IRA grow, potentially tax-free. And so what I mean by that is we're going to wait till we're 59 and a half. If we do conversions, we're going to wait the 5 years, but we'll assume that you pass those little tests. And then later on down the line, the reward is you get to take that money out tax-free. Or is it better to keep your money liquid? And the reason you might keep your money liquid in the taxable bucket is that we don't have to worry about the 59 and a half rule. We know that if we make earnings on that money, that there's going to be some tax implications, but we want money to pay the mortgage, etc. Or is it better to put money into a tax deferred bucket? So we need the tax break now. Maybe we're in a really high tax bracket, so we'd prefer to put the money there, let those grow tax deferred, because remember, at some point you will be paying the tax, and you're banking on the fact that maybe later on I'm in a lower tax bracket, or maybe the taxes are lower. I'm okay waiting until that time to take it out and then pay the taxes at that time. And the truth of the matter is you may have some money in all of these buckets, but what's the right mix? And that's kind of the secret sauce. All right, so we're going to take a look at twin brothers. And why are we going to look at twin brothers? Because twins do everything exactly the same with one exception. And so in this case study, and keep in mind that this is not, in real life, this probably wouldn't necessarily happen, but for the purposes of illustrating some points, we're going to do it this way. So we have twin brothers, Al and Bob. And Al and Bob are 35 years old. They're in their mid-30s, and they've decided, you know what? We need to start putting some money away. We need to start getting some money into our retirement accounts. Both Al and Bob have decided that they can put up to $5,000 a year into their retirement accounts, but they have a slightly different philosophy as far as where do we want to put the money. Al wants the tax break now, so Al puts money into a traditional IRA. So he's putting $5,000 in, and Bob is going to contribute $3,500 to a Roth IRA. Now, why is he contributing less? Well, because remember, when you make a contribution to the Roth IRA, this is money that has already been taxed. So to make the game fair and to make it, this equal, so to speak, we have to account for the tax. And I was generous with the tax. I said that we're going to just assume there's a 30% tax. That's probably fairly common. Remember earlier we said that most Americans are right around 33%, but we're just going to say 30%. So they're going to do this starting at age 35, and they're going to do this for 30 years. So they're expecting to retire when they hit the age of 65. So there are some assumptions we have to put in here. And the assumptions are that both Al and Bob are going to be at the exact same tax rate for this entire period, and their earnings are identical. And so Al makes exactly the same returns in the traditional IRA. Bob makes exactly the same returns because we have to do potatoes to potatoes, so to speak. And so now it's 30 years later. They're age 65, and we ask, well, who has more money in their retirement account? So Al actually has more money in his retirement account. Al has grown his account. And by the way, I think I did an assumption of 8% or whatever the growth was on this. So they are actually making earnings every year. And so Al has almost $200,000 more in his account, and Al is tax deferred. And remember, the other account's a Roth account. So that's a little bit surprising. The traditional IRA seems to be doing better. It's a much bigger account. But now the more important question is remember, in a tax deferred account, even though Al has $600,000 on paper, the reality is if he takes money out of that account, does he really have $611,000? The answer is no, because as soon as he takes money out of that account, the IRS is going to get some of that money. So assuming he pays taxes at that same rate of 30%, guess what? They both have the exact same identical amount of money. The Roth IRA has 428,000, and after I think it was Al pays his taxes, he has $428,000 exactly. So why is it the same? Because everything was identical. The tax rate never changed. Their returns were the same. And so I did it this way on purpose. And the reason I did it this way on purpose is that in this situation, one account is not better than the other because everything is the same. The tax rates never change. Nothing is ever altered, so to speak. But I want to ask this question. What happens if the tax rate increases by 2% when the brothers retire? And what happens if the tax rate increases, for that matter, during the time that they're putting money away? And by the way, the tax brackets that we currently have, if Congress does nothing, this is roughly what the increase will be on each bracket, so to speak. Then the Roth wins. So if tax rates are higher in the future, the Roth is better. We could do the flip, and we could say, well, if taxes go down, then the traditional IRA, because we're paying less tax in the future. So this is one of those things, we don't have a crystal ball. But what do we think is going to happen to tax rates in the future? Do we think they're going up? Are they going to stay the same? Or are we going to lower the tax rates? That has to factor into your decision. If taxes are likely to be higher, you're better off paying your taxes now when they're on sale. If tax rates are likely to be lower, then you want to wait. I don't want to pay the taxes now. So we just wanted to give that as a specific example. So we're going to take this a little bit further. Now, in this example with Al and Bob, we were talking about retirement accounts. Do we want to put money in a traditional IRA? Do we want to put money in a Roth IRA? So that we're just talking about retirement accounts. Well, let's take a little bit different look. Now we have twin sisters, Amy and Sue, and each sister has $100,000, and they hit a jackpot at the casino. I don't know, but they ran into $100,000 that they each have, and they want to invest that money. So one of the sisters decides to put that investment, and this, by the way, this is in the taxable bucket. They just have $100,000 sitting in a savings account. This is in the taxable bucket. And she wants to put that money into an investment that earns 10%. The other sister, and we're going to assume that somehow she did a Roth conversion, or anyway, she did something, but she's going to move her investment into a Roth IRA. So the reason I'm showing a tax on that is that the money that she's getting to fund the Roth IRA had to be taxed at some point in time. So the one sister starting with 100,000, the other starting with 70,000, and they're going to put their money to work. And so just to give you an idea of how this works, at the end of year one, Amy, who has $100,000 to work with, and she's earning 10%, and I did it just to make the math simple, her interest or her earnings are $10,000. Now she has to pay taxes on the earnings. So 3,000 of that goes to pay the taxes. The rest goes back in to be reinvested. So whatever she makes that's left over gets reinvested. Now Sue, on the other hand, remember she has $70,000. She earns the same return, 10%. And so $7,000 in interest, but because she's in a Roth, she doesn't pay any taxes, and she's just going to reinvest her money. So we're going to rinse and repeat. Every year, they're going to make 10%. Amy's going to pay taxes, Sue isn't, but we're going to do this for 20 years, and we're going to take a look at, well, what's the outcome? So in 20 years, Amy, who's in the taxable account, is going to have let's just call it $387,000 of just money in a taxable account, money she can take it and invest any way she wants. She can, go on vacations, whatever. She's done good. She's more than tripled her money, right? She's almost, quadrupled her money. Now Sue, who's in a Roth account, has done a little bit better. She hasn't quite earned, but almost just about $85,000 more in her Roth account. And so now both these sisters are age 60, and they decide it's time, they're ready to retire. And so they want to start, having some fun with this money. And so what they decide to do is they want to just withdraw the earnings or the interest. I use the word interest, but they don't want to dig into that pile of money. So they're only going to take out the earnings that they have. And so at this point, Amy can take out $27,000 every year from her nest egg of about $387,000. And remember, she's getting taxed every year. Sue, on the other hand, can take out about $47,000. And remember that when she takes money out, because she's old enough and the money's been in there long enough, she doesn't pay any tax. So one of the questions I think that's important to ask is, we went for 20 years. And the question is, how long did it take for Sue, who was in the Roth account, to get to a cash balance that's the same as Amy's? And it was 13 years. I bring this up because time is one of the factors that you have to consider. How long do you want this money to go? So if I leave it in a taxable account, how long do I think I'm going to have that money before I need it, before I plan on taking that money out? Because that's a part of the equation we have to take into consideration. So if they started taking money out, say in year 8, it may not look quite as good for the Roth account. So let's go through a few takeaways, and hopefully these examples help to drive home some of those points. When we're talking about the different buckets of money, do we want to keep money in the taxable? Do we want it in the tax deferred, or do we want them in those like just Roth or HSA type accounts? Tax rates definitely matter. We don't have control. I mean, we can vote for our local congressperson and senators, but we personally don't have a lot of control over the tax rates. Tax rates can be changed. We've had Congress raise them, lower them, keep them the same, but that's something that you have to factor. What do you think is going to happen with those tax rates? Remember, if Congress does nothing, taxes are going to go up January 1st, 2026. All they have to do is let the current tax rates expire. So as a general rule of thumb, and this makes this total common sense, if it's likely that taxes are going to be higher in the future, you want to pay now. It's a little bit like inflation. If you buy a house now, the odds are, because of inflation and other factors, that house is going to cost more as time goes on. If you believe taxes are going to be lower in the future, you're better to defer those taxes. Why would you pay taxes now if you feel like taxes are going to be lower in the future? Time matters, and I hope through the examples that we gave, whether it's that penny doubling every single day, or the two twin sisters that are going to wait 20 years, or the two brothers, time makes a difference. And so in general, the more time you have to grow and compound, typically the better you are in a tax-free investment vehicle. If you're going to need your money sooner than later, the money's not going to have a lot of time to grow and compound, then a tax-free vehicle might not make as much sense. I think personal circumstances make a difference. And here's what I mean by that. A lot of times these decisions, it depends on your situation right now. And so your personal situation can change. So you may, as an example, have inherited some money, and all of a sudden you're in a high tax bracket. Maybe you're in a job where you're in you just make a lot of income. That matters. That makes a difference. But remember the example I gave of the husband and wife that were like around 60 years of age, and they were both getting ready to retire. Well, they were going to be in a window where their income was going down significantly. So you might have a year that maybe you were unemployed for a period of time, or maybe you retired and your income went down, so your tax bracket is lower. So it might make sense to go ahead and pay some taxes at that lower tax rate while your tax bracket is lower. And I think the other thing is that this is math. Most of these decisions, you have to do some calculations, and you have to factor in some assumptions. There are some assumptions like, what will the tax brackets be when I need this money? And what do I think my tax bracket will be? And one of the things that I think a lot of retirees find and are a little bit surprised by is that there's this automatic assumption that when I retire, I'll be in a lower tax bracket. But what's interesting is that there are some reasons why that doesn't necessarily happen. And some of the reasons are, a lot of times when people hit retirement, they've paid for their house. And so some of those deductions that they've had through the years, like the interest on the mortgage, maybe they've had some expenses on a business that they've run, but now they're retired, those go away. They no longer have children that they can, they get the tax break for having kids. So some of the tax breaks that you had when you were working and maybe had children, those go away. And so sometimes people are surprised at where they actually land in that tax bracket. And really, honestly, at the end of the day, is involve a professional, a CPA or a financial advisor into these decisions. Where should I be investing my money? Taxable, tax deferred, or tax free? So just as a reminder, if you do have any questions, please do type those in. We're getting close to the end now, and I will go ahead and answer as many of those questions as I can. I did just want to remind people that here at New Direction Trust, we offer retirement accounts that you're able to self-direct, and wanted to remind you that we offer quite a wide variety of these accounts. So we offer traditional IRAs, Roth IRAs, health savings accounts. We also offer solo 401k plan, and that plan can be set up so that there is a Roth 401k built into that plan. And then the simple and SEP IRAs, we're going to have the ability, if you happen to be self-employed or you own a small business, that you could have a Roth component for those plans as well. And so just wanted to remind you that that's where we work with clients, is on the retirement plan side. And I'm going to shift gears now, and let's take a look at some of the questions. And I'm going to read these out loud. And if for some reason it wasn't quite the question that you were thinking, by all means, feel free to reach out. I'm going to put our contact information up here in a bit. So the first question is asking if an individual has already converted their IRA to a Roth IRA, and that income and that individual has higher income than the limits. How does one make a contribution to this Roth? Okay, that's actually a good question. You'll want to look into, here's the key type of retirement account that you want to think of. It's called a non-deductible IRA. So what it is it's going to be a traditional IRA, but it's going to be a non-deductible. What does non-deductible mean? Non-deductible means that you're not basically taking the tax deduction. And so anybody is eligible to contribute to a non-deductible traditional IRA. So it doesn't matter how much income you make, but when you make that contribution, you don't get the tax break. Now, once it's in the non-deductible traditional IRA, you can do a conversion. The other way you can get money into that Roth IRA is if you happen to own a business. If you own a business, then you may be eligible for an employer-based retirement account, like a solo 401k, a SEP IRA, maybe a simple IRA. Remember now that you can make contributions to an employer-based retirement account, not an individual account like an IRA, but the employer accounts, they are not subject to those income limitations. So there's two ways that you could potentially get money into that Roth. One is using a non-deductible IRA. The other is to put money first into an employer-based Roth type plan. So maybe you have a SEP IRA and you make contributions to a SEP Roth IRA or a Roth 401k, which we offer through those solo 401k plans. Once the money is contributed to that Roth, whether it's a Roth 401k, Roth SEP IRA, those can then be rolled into the Roth IRA if you want to. So there's a couple different ways. Good question, but there's a couple different ways that you can do that. Okay, the next question. The question is asking, the government's considering the conversion of the dollar to a digital dollar for control of how you're using your money, tracking your funds to make sure they're collecting taxes or other fees. How will this affect the way you can invest or contribute to IRA or accounts? I'm going to pass on that question, and only because it's a hypothetical. And I know it's an interesting question, but it's one that I don't think we necessarily know the answer to be totally honest. And so I'm going to have to stay focused on things that I know are here in the right now. But gosh, who knows? We'll see. So somebody's asking, please show how a penny doubled every day for 30 days becomes, we said the 5,368,000. I would be more than happy to show you. It's basically just a spreadsheet. And I'm going to jump, just so you know, if you'll reach out to that email there, education@ndtco.com, I'd be more than happy to share. It's just a spreadsheet where it shows a penny doubled every day, and I'd be happy to share that with you. I don't have it at my fingertips at the moment, but I'd be happy to share that with you. But good question. I know it doesn't seem possible, right? Okay, so the next question is asking, can you tell us where we can find the information regarding withdrawals before 59.5 from the Roth? Is there an article or something on NDTCO that we can refer to? So yes, we have a section on the website, and where we talk about the different types of accounts. And one of the accounts that we talk about is the Roth IRA, and it does talk about those rules. I will also say, if you're still on board with me, if you'll reach out to that education at ndtco.com, I would be happy to send you something that it kind of just lays it out in like a PDF version, where in Roths, it's interesting. We have 3 kinds of money that can be in there. We have money that's been contributed. We have earnings or growth, when that money grows, and we could also have converted money. So money that we converted in order to get into the Roth. So all 3 of them have slightly different rules, and it is important to understand what those rules are. But I'm more than happy to share that. We would also have that on the website when you look under the Roth IRAs. Oh, okay. So the individual who wanted to know how a penny doubled every day for 30 days just said that they must have figured it out for themselves. But anyway, that's great. But yeah, but by all means, reach out, give us a call, send us an email, and we'll be more than happy to answer those questions. So the next question is asking, what is stopping me from starting a consulting firm, like an LLC, then contributing as much as I want to my Roth IRA? So this is an interesting question. So, and I'm glad this question was asked, because I want to really break this one down. So if you have a consulting firm and you're operating an LLC, you're making income. I'm assuming that this is a profitable business and you're making income. What could be stopping you from contributing to a Roth IRA is if you make too much income. And by income, I'm talking about earnings that are subject to FICA, Social Security, income tax. So we're talking mostly about like W-2 wages. So if you're paying yourself salary and you're making more than the thresholds we mentioned earlier, so like if you're filing single, it's around 120 some thousand, or if you're married filing joint, starts at around 220,000. So if you make too much income, you're not able to directly contribute to a Roth IRA. If you make less than those, you can contribute to a Roth IRA. There's nothing stopping you. It has to do with your income, your reported income. But additionally, I'm glad you mentioned that you're doing this in an LLC. An LLC is a corporate entity. And as a corporate entity, that LLC could be eligible possibly for a SEP IRA, especially if you're just like working on your own. It could be eligible for a solo 401k. It could be eligible for a simple IRA. So if you happen to have maybe some employees in there, but the reason I mention that is that you could contribute to 2 kinds of Roth accounts. You could contribute to a Roth IRA, but you might possibly be eligible to contribute to a Roth solo 401k, like a 401k type contribution. It could be a SEP 401k. So there's a chance you could actually contribute to 2 different buckets of Roth, the individual IRA, the IRA, and also those employer type accounts. But that's a good question. I'm glad this question came up. And I actually was wanting to address this, but the question is, I have a traditional IRA, and it's invested in real estate, and there's a little bit of cash. And so the question is, if I want to convert to a Roth IRA, do I have to pay tax on the total value of the account? And then there's some other information added in about age and that the individual is working. So I want to tell, so if you have an asset in a traditional IRA, or possibly even in like a 401k, it is possible to do a conversion of an asset. So in this case, this individual owns real estate. when you do a conversion, what you would have to determine is a fair market value for that real estate. And then what's interesting is you don't have to convert the entire account. And so in this situation, you could convert just the cash, you could convert just the real estate, you could do a little bit of a combination. And what the good news is you can actually do partial conversions. And so that means you could, it seems weird, but you can do a partial conversion of the real estate. And so what would happen is, and I'll just use a simple example. Right now, your traditional IRA owns 100% of this property, I'm assuming. You could say, you know what, I want to convert half. So what would happen is we'd need to know, well, how much is this property worth? Because we have to have a dollar figure to work with. And we would say, all right, if you're going to convert half, that equals X amount of dollars. We'll issue you a 1099, and that would become a taxable event. And what you would do is you would file a new deed in the county where that property is owned. And now the new deed will show that the Roth IRA owns 50% and the traditional IRA owns the other 50%. Now it gets interesting because I'm assuming this is an investment property and maybe you have rents coming in. What that means is half the rents are going to go to the Roth because he did a conversion. Half the rents are going to go to the traditional IRA. And so what's interesting is now you can take the rents in the Roth, and you mentioned your age, and I'm just going to say this individual's over the age of 59 and a half, and you can now begin to withdraw those rents essentially tax-free. This gentleman mentioned, or this person I should say, mentioned their age and mentioned that they are still working. And in general, your age does make a difference. And the reason it makes a difference is how long do you think those accounts have to grow? So one of the factors, one of the things you have to take into consideration is that when you do a Roth conversion, that there is a 5-year clock that starts ticking on that Roth conversion. And I would say, remember that before you can access the converted money, you have to satisfy that 5-year clock. And so I would say discuss that with your CPA and see if that makes sense for you and your age. But the bottom line is that you can do partial conversions. You don't have to convert an entire account. Partial conversions are acceptable, and you can convert what I would call hard assets, things like precious metals, things like real estate, things that are physical items that you own within an account. So the next question is asking, if an individual has an existing Roth account, are there restrictions to rolling it over to a self-directed Roth account? The answer is no. And the reason why is that you would just have a self-directed Roth IRA. So the accounts that we use, the accounts that our clients have access to, they're actually the same accounts that you would have with any other financial institution. The underlying account is still a Roth IRA, and you can transfer from Roth IRA to Roth IRA. You can absolutely move the funds. That's a good question. Okay. Well, folks, that's the end of the questions that I see for today, but I just wanted to point out that if 5 minutes from now, all of a sudden a question comes up, we would encourage you to reach out, give us a call, send us an email. And if I didn't quite answer your question and you're still a little bit confused, please reach out, and then in the topic, mention something about, forever tax versus never tax webinar, or my name is Chris. Just say attention Chris or something like that. Like I know one of you was interested in like the Roth and how do we know the difference between money that we can take out and the 59 and a half and the 5-year rule can be a little bit confusing. I'd be happy to share some information that I think clarifies and helps make that a little bit more understandable. But with that, I hope you enjoyed today's webinar. And we thank you for attending. And there will be an email coming out. So we will have a recorded version that's going out as well. So be on the lookout for that tomorrow. And feel free to take a look at this again if there were some pieces you just needed clarification on. But everyone take care and have a wonderful day. Take care.